Let's talk about money. It's a topic that often brings a mix of excitement and anxiety. Whether you're discussing it with friends over coffee or in a serious business meeting, money is always a hot topic. Specifically, let's talk about making millions. The idea of becoming a millionaire might seem far-fetched to some, but it's a goal that many aspire to. It might sound like a dream, but it's possible. With the right strategies and a bit of luck, you can turn that dream into reality. One path to consider is the stock market. It's a dynamic and ever-changing landscape that offers numerous opportunities for those willing to take the plunge. It's not a get-rich-quick scheme. Many people make the mistake of thinking they can make a fortune overnight, but that's rarely the case. It takes time, patience, and smart decisions. You need to be willing to put in the effort to research and understand the market. This guide will teach you the basics of investing in stocks. We'll start with the fundamentals and gradually move on to more advanced topics. We'll cover everything from picking the right investments to managing your risk. Remember, knowledge is power. The more you know, the better equipped you'll be to make informed decisions. Investing in the stock market can be intimidating. The constant fluctuations and the sheer volume of information can be overwhelming. But it doesn't have to be. With the right guidance and a clear understanding of the basics, you can navigate the market with confidence. We're going to break it down into easy-to-understand steps. From understanding market trends to knowing when to buy and sell, we'll cover it all. Get ready to learn how to make your money work for you. Let's dive in. By the end of this guide, you'll have a solid foundation to start your investment journey. So, grab a notebook, take some notes, and let's get started on the path to financial success. What exactly are stocks? They're tiny pieces of ownership in companies. When you buy stock, you're buying a small slice of that company. Why should you care? Because owning stocks can help you build wealth over time. Companies can grow and become more valuable. When that happens, your stock becomes more valuable too. Think of it like owning a piece of a pie. As the pie gets bigger, so does your slice. Of course, there are risks involved. The stock market goes up and down. But over the long haul, stocks have historically outperformed other investments. Before you buy a single share of stock, educate yourself thoroughly. Understand exactly what you're investing in and why. Don't rely on rumors, hearsay, or hot tips. Read books, take online courses, and learn from reputable sources consistently. The more you know, the better decisions you'll make. Remember, knowledge is power. The stock market is like any other specialized field. You wouldn't perform surgery without studying medicine, would you? Of course not. The same principle applies to investing wisely. Invest in your financial education first and foremost. It's the best investment you can make for your future. To buy and sell stocks, you'll need a broker. A broker is like a middleman between you and the stock market. There are many different brokers out there. Do your research and find one that fits your needs. Look for a broker with low fees, a user-friendly platform, and good customer service. Don't be afraid to shop around. Compare fees and services. Find a broker you trust and feel comfortable with. Remember, your broker is your partner in this journey. Choose wisely. Diversification. Don't put all your eggs in one basket. You've heard the saying, don't put all your eggs in one basket. It's a timeless piece of advice that applies to many aspects of life, but it's especially relevant when it comes to investing. Well, that definitely applies to investing too. When you invest, you want to spread your risk so that a single event doesn't wipe out your entire portfolio. Diversification means spreading your money across different investments. This way, if one investment performs poorly, others might perform well, balancing out the overall risk. Don't put all your money into one stock. Imagine if you invested everything in a single company, and that company faced a downturn. What if that company goes belly up? You could lose everything. This is why it's crucial to diversify your investments. Instead, invest in a variety of stocks across different industries. By doing this, you are not overly exposed to the risks of any single sector. A great way to diversify is through index funds and ETFs. These funds pool money from many investors to buy a broad range of stocks or other securities. These investments track a specific market index, like the S&P 500. This means you get a small piece of many different companies, reducing your risk. They offer instant diversification and are a great option for beginners. With just one investment, you can own a slice of hundreds of companies. Diversification helps reduce your risk. It's like having an umbrella to protect your money from the stormy weather of the stock market. It's like having a safety net for your investments. By spreading your money across different assets, you create a buffer against potential losses, ensuring that your financial future remains secure. Remember, the goal of diversification is not just to minimize risk, but also to maximize potential returns over the long term. By carefully selecting a mix of investments, you can achieve a balanced portfolio that grows steadily over time. So don't put all your eggs in one basket. Diversify your investments and build a resilient portfolio that can weather any financial storm. Dividends and growth. Finding the right balance. Some companies pay dividends. Dividends are like bonuses paid to shareholders. They're a portion of the company's profits. Other companies focus on growth. They reinvest their profits back into the business. This can lead to higher stock prices in the long run. There's no right or wrong answer when it comes to dividends and growth. It depends on your individual goals and risk tolerance. Some investors prefer the steady income stream of dividends. Others prefer the potential for higher returns with growth stocks. Finding the right balance is key. Time is your friend, the power of long-term investing. The stock market is a marathon, not a sprint. Don't expect to get rich quick. It takes time to build wealth through stocks. Be patient and think long-term. Don't panic when the market dips. Those dips are buying opportunities. The longer you stay invested, the more time your money has to grow. Compounding works its magic over time. Rome wasn't built in a day, and neither is a million-dollar portfolio. But with patience and discipline, you can achieve your financial goals. Emotional investing, your worst enemy. Emotions and investing don't mix. Don't panic sell when the market drops. Don't get greedy and chase after hot stocks. Stick to your plan and make rational decisions. Remember, the stock market is cyclical. It goes up and down. Don't let short-term fluctuations derail your long-term goals. Stay calm, stay disciplined, and stay the course. That's how you win in the stock market. Risk management, protecting your hard-earned money. Investing always involves risk. Whether you're a seasoned investor or just starting out, understanding how to manage that risk is crucial. But you can manage that risk. By taking the right steps, you can protect your investments and ensure that your financial future remains secure. Don't invest more than you can afford to lose. This is a fundamental rule in investing. Always assess your financial situation and determine how much you can comfortably set aside for investments without jeopardizing your daily needs. Have an emergency fund in place before you invest in stocks. An emergency fund acts as a financial safety net, ensuring that you have funds available for unexpected expenses, such as medical bills or urgent repairs. That way, if life throws you a curveball, you won't be forced to sell your investments at a loss. Consider setting stop-loss orders. These orders can be a valuable tool in your risk management strategy. A stop-loss order automatically sells your stock if it drops below a certain price. This helps to limit potential losses and protect your investment portfolio from significant downturns. This can help limit your losses. By setting a predetermined exit point, you can avoid emotional decision-making and stick to your investment plan. Risk management is about protecting your hard-earned money. It's about being proactive and taking steps to safeguard your investments. It's not about avoiding risk altogether. Every investment carries some level of risk, but with proper management, you can minimize the impact of those risks. It's about taking calculated risks and managing your downside. By understanding the potential risks and rewards, you can make informed decisions that align with your financial goals. Remember, the key to successful investing is not just about making profits, but also about protecting your capital. Patience is key. So, there you have it, the basics of making millions from stocks. Remember, it's not about getting rich quick. It's about making smart decisions and staying disciplined over the long haul. Don't be intimidated by the stock market. Educate yourself, find a good broker, and start investing. Remember to diversify your portfolio, manage your risk, and most importantly, be patient. Building wealth takes time, but with patience and perseverance, you can achieve your financial goals, and the rewards can be life-changing. If you'd like to see a detailed video on the best brokers in the market and how to choose the right stocks to start investing in, let me know in the comments section below. Your feedback helps guide the next video to ensure it's packed with the most useful information for your financial journey. Now go out there and make those millions. If this guide was helpful, be sure to like and subscribe for more investment tips and strategies.